Friends, please pause what you're doing and listen to me about a recent event that has shocked the financial world. In the past month, an extremely rare phenomenon has occurred on Wall Street, for top players have taken almost identical actions simultaneously. First, Warren Buffett's Berkshire Hathaway's cash reserves surged to a record high of $397.38 billion. Second, 24-year-old Wall Street rising star Leo Pitt used $7.46 billion to short Nvidia. Third, renowned short seller Michael Burry publicly pointed out that Nvidia's purchasing commitments had increased 5.9 times in a year. Fourth, Howard Marks of Oaktree Capital publicly stated that the market was perplexing and that he was holding cash and waiting. These four individuals, who rarely communicate, have all chosen to retreat. And what about ordinary retail investors? They are still chasing high prices, adding to their positions, and fantasizing that AI stocks can rise another fivefold, reaching $60,000 per share. So, what exactly are they doing? Can ordinary people learn from their experiences? Below, I will analyze these 5 events one by one using real data. First thing, hoard cash, Buffett's strategy. On May 2, 2026, Berkshire Hathaway released its first quarter financial report, showing cash reserves of $397.38 billion, approximately 2.7 trillion renminbi, accounting for 58.2% of total assets, exceeding the market value of its stock holdings for the first time. In other words, Buffett withdrew more than half of his assets from stocks and converted them into cash. What does this mean? A stock market guru who has long emphasized buying good companies and holding them for the long term is now choosing cash as king. This is a silent strategic signal, a warning that market risks are accumulating. Especially considering that in 2025, Berkshire Hathaway's stock price underperformed the S&P 500 index. By 2026, Berkshire Hathaway was down 5.9%, while the S&P 500 was up 5.62%, a difference of more than 11 percentage points. Furthermore, Berkshire Hathaway placed its cash in 3 to 6 month short-term U.S. Treasury bonds. At a 5% yield, this would generate nearly $15 billion in risk-free income annually, equivalent to the annual profit of a small bank. Buffett's actions tell us, now is not the time to attack, but to defend and wait for the real opportunity. Here are some practices that ordinary investors can learn from. 1. Keep 20% to 30% of your portfolio in cash. 2. Don't keep cash in low-interest savings accounts. Instead, put it in money market funds or short-term government bond ETFs. 3. Avoid chasing high prices, save your resources for real opportunities. The second thing, identifying overvaluation, Leo Pitt shorting Nvidia. On May 18, 2026, Leo Pitt disclosed his holdings report, showing that his fund size had surged from $5.5 billion to $13.67 billion, a 1.5-fold increase in 6 months. Even more impressively, he used $7.46 billion to establish put options, shorting companies in the AI chip industry chain, including Nvidia, AMD, Micron, and TSMC, accounting for nearly 50% of his portfolio. Leo Pitt's rationale. The future bottleneck for the AI industry is not chips, but rather limitations in power supply, physical space, and computing power. He believes Nvidia's valuation is too high and there is a risk of a bubble. Ordinary people should not directly imitate short selling, but they can. 1. Be wary of the downside risk of overvalued AI stocks and avoid heavy positions at high levels. 2. Focus on undervalued long-term sectors such as energy and data centers. Additional information. Leo Pitt graduated from Stanford and entered AI research at the age of 20. His understanding of AI allows him to see the ceiling of chip valuations. His investors include top institutions such as the Dartmouth Alumni Fund and the Harvard Endowment. Third point, identify the risks of supply chain commitments, Michael Burry. Burry points out that Nvidia's current purchase commitments amount to $95.2 billion, compared to only $16.1 billion a year ago, an increase of 5.9 times. Every surge in purchase commitments of more than 5 times is often accompanied by a demand inflection point. Historically, for example, during the 2021 cryptocurrency bull market, purchase commitments surged, and the 2022 cryptocurrency bear market caused Nvidia's market value to drop by as much as 60%. Burley also shorts the entire semiconductor sector, including Broadcom and AMD, almost identical to Leo Pitt's assessment. Ordinary people should 1. Not be misled by high-growth stories. 2. Pay attention to the gap between supply chain commitments and reality. 3. Pay attention to downstream demand. Even a 5% slowdown can be amplified tenfold upstream. Fourth thing, waiting for the right opportunity, Howard Marks. Howard Marks states that the current market is perplexing, but not dangerous, rather, it's an unreasonable surge from high levels. Having experienced the 1987 stock market crash, the 2000 dot-com bubble, the 2008 financial crisis, the 2020 pandemic-induced market collapse, and the 2022 interest rate hike bear market, he chooses to hold cash and wait for a historic correction. Ordinary people can learn from this. 1. Observe market sentiment indicators, Buffett indicator, VIX index, P/E ratio, etc. 2. Do not add to positions at high levels, set a clear waiting plan. 3. Clearly define what opportunity you are waiting for, such as a 20% market correction or individual stocks falling back to reasonable valuations. Fifth thing, safe haven heavy investment, gold allocation. Global central banks are hoarding gold, and Chinese consumers are buying large amounts of gold bars and coins, indicating a rising awareness of safe haven assets. In the first quarter of 2026, China's gold consumption reached 303.292 tons, a year-on-year increase of 4.41%, with gold bars and coins surging by 46.4%, while gold jewelry consumption decreased by 37.1%. Advice for ordinary investors. 1. Allocate 5% to 10% of your portfolio to safe haven assets, gold, silver, short-term government bonds. 2. Avoid overconcentration in a single sector. 3. Buy in batches to reduce risk exposure. Summary: 5 core principles from 4 top players. 1. Cash is king, maintain liquidity. 2. Be wary of high valuations and identify bottlenecks. 3. Pay attention to the gap between supply chain commitments and reality. 4. Hold cash and wait at market highs. 5. Allocate to safe haven assets to reduce risk concentration. 5-step action plan. 1. Check cash ratio, adjust if it falls below 20% to 30%. 2. Be wary of overvalued AI stocks, avoid blindly chasing high prices. 3. Pay attention to the shift in supply chain bottlenecks and position yourself for future sectors. 4. Allocate 5% to 10% to safe haven assets to improve stability. 5. Develop a clear waiting plan and proactively seize opportunities. Key principle: remain calm in euphoria and rational in panic. History tells us that only a few patient individuals can acquire quality assets at low prices and achieve a leap in wealth, while most retail investors often become victims. A qualitative change in wealth does not rely on a single surge or precise market timing, but rather on counterintuitive patience and strategic planning.